Shah, the Executive Director and Fund Manager with Emkay Investment Managers. So firstly, to start off with, you are quite bullish when it comes to the CDMO space and in the pharma sector as well. Given the fact that there's a Biosecure Act which is expected to come in the US recently, and but there are a few negative news also, given the fact that some concerns are being shown on the drug pricing so far. So, how are you positioning yourself in the pharma sector? Where are you more bullish in the pharma sector as of now?
Yeah, hi. Thanks for having me on the show. So, basically, as you rightly mentioned, we are fairly overweight on the pharma as a space, and within that, we have chosen to be in the CDMO CRAM space and also in the specialty drugs business. So, the reason why we believe that the CDMO and the CRAMS has, it's a it's a very highly profitable business. It has very high entry barriers, and it has a very long runway of growth for at least next 3, 5, 7, 10 years. Already in the last 5, 7, 10 years, I think it has accelerated. But we believe that Indian companies are at an inflection point where if you just observe the kind of the capex that some of these companies have done or are continuously doing. In terms of what used to be the capex of 5 years cumulative or is now probably a 2 year capex kind of thing. So that's and obviously when these companies are doing this kind of capex, they are getting a lot of confidence, probably a lot of software commitments from their customers, and these customers are very large global pharma majors across the globe. So there is clearly this global alternate supply chains that we all keep on talking about getting created. CDMO and CRAMS is definitely one of them. And within that, I think the Indian corporates have very clearly demonstrated that they have the right to win because they have showcased that they have the domain expertise. They respect the intellectual property rights, and they have also created capacities to take care of the global demand. So I think, and of course, the chemical in terms of the domain expertise, I think the kind of the chemistry skills and the overall talent pool that this country has, I think it's one of the best in the world, which is what is attracting global majors, to keep on giving more and more products, either at the R&D side or even then when these products go in the commercial phase also. So the large scale production orders are also coming to Indian companies.
Right. Given that you're quite bullish when it comes to the CDMO space, you might be holding, or you definitely might be holding Divi's as one of your stock in the portfolio, given that it is one of the largest player in the CDMO. But given the negative news that we have been getting on the Entresto drug, for which Divi's has a contract with Novartis to supply raw materials for the same. Do you see that to be a big impact or a big negative for the company here?
Basically the overall R&D space is a game of probability. So there will always be hits and misses. The point here is that if your customers, I mean, you mentioned the name of Novartis, and whether it is Novartis or the Glaxo or the Pfizers of the world, if they have confidence in you as a vendor, as a contract manufacturer, if not this drug, they will make sure that for the capacities that you have actually installed, they will make sure that your capacities get utilized over a period of time. Maybe there will always be some lead lag effect. But generally, we have seen that with these large customers, whenever you install some large capacities, they over a period of time take care by giving you some other products. So I think this one or two products is not a story that we try to play here because BBs or Laura's or any of these companies are not product companies; they are pure contract manufacturers. So the product risk is always with the large companies or the actual original OEs as we call them. But more than that, I think it's that they have multiple products and they will always keep on giving one or the other products. We've seen that multiple times in the past also.
The other space, Sachin, which has the street divided, is autos, because on one end you have that entire energy transition theme and the kind of new launches which are coming up after a long, long time that has part of the street excited. The other half is still worried about the consumption patterns and how there is a bit of a moderation when it comes to urban demand. Do you think auto ancillaries are better placed perhaps than the frontline two-wheeler, four-wheeler stocks?
Again, within the auto space, so as you rightly said, auto and auto ancillary. So let me just first talk a little bit on the auto side, how we perceive it. Overall domestic volume growth, whether it is passenger vehicles or whether it is two-wheelers, I think probably most of the people, there's a consensus, even from the company's side, that the volume growth will be in the range of maybe, mid-single digit to high single digit over the next 3 to 5 years. But I think the real story that the way we want to participate is the game of premiumization. Because today that is where the fun is, and that is where the value added growth is also coming for all these companies. So you may have a 4, 5, 7% kind of a volume growth, but because of the premiumization from the customer side, a classic example is today gives you a value growth in terms of your revenue growth of double digit. Within that also, within SUVs also, I think customers are more looking at higher premium variants, not just the base variant, which used to be the largest selling model or the second lowest model, used to be the highest variant. Now it's the top most or the second topmost model, which have become the highest selling variants for each of the models. So again, there's a value addition or a premiumization story playing out there. We believe that wherever there's a premiumization story in whichever companies within the auto OEs, that they may be better placed. Coming to, I think, auto ancillaries also, it's not only about the domestic markets, but I think they have global markets as their audience and or their target markets. So, again, there we believe that these global alternate supply chains are getting created. And some of these companies have demonstrated to their partners over there that they have the size, scale, quality, which is what we believe that is again a very, very secular long-term story for auto ancillaries.
You're also quite bullish when it comes to the electronic manufacturing sector as well. But aren't you worried about the valuations right now, given the sharp run-up that we have seen in all the stocks in the sector, be it Dixon, Amber, or for that matter, PG Electroplast? All the stocks have run up quite a lot, right?
Sure, I completely agree with you that the valuations over there are probably stretched at this point in time. So one will have to be extremely selective, and we are not overweight in that sector at this point in time for sure. So yes, valuations is something, because although the growth rates of these businesses continue to be very decent in upwards of maybe anywhere in the range of 25 to 40% depending on company to company, but the valuations are probably pricing in most of it, at least for next 2 3 years. So I agree with you that the risk reward is probably not in favor at this point in time for EMS companies.
Okay, Sachin, on that note, we let you go. Thanks so much for making time and speaking with us. So, the electronic manufacturing theme is quite okay, but the valuation has become punchy, so be careful of that.